Hi, this is Eric Boyce, the CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for August 3rd, 2020. Please see our disclaimer for important information. So in our first slide this week, we look at a ranking of some of the worst quarters that we've ever seen in terms of economic contraction. And where does the recently released data fit in with that? So we know that the GDP on this first revision, it's first pass. So we get 3 revisions total of every quarterly GDP number. And so this is the first pass, if you will, and it was a negative 32.9% on an annualized basis. So just think about that. That's fairly profound. Again, we knew it was going to be bad. First quarter annualized growth was down around 5%, but we had really about a month and a half of fairly solid pre-COVID growth before March really set in. But we knew that it was going to be bad. But if you look towards the left in some of those resoundingly negative figures, you can see that 1946, the first quarter of that year, after the really after the war machine, manufacturing machine kind of wound down following World War II, that was obviously very negative. And then you've got a couple of quarters in 1932 that were really in the throes of the Great Depression. So, you know, if you look at some profound transition points in history, you can see that what happened in the second quarter certainly ranks among them. And again, if you continue to scroll to your right, I mean, you're really not seeing anything in the modern day. So with the lone exception perhaps of that 1946 number, and then at the far right you have the immediate aftermath, if you will, or kind of where we have the 2 atomic bombs and the cessation of activities in the Pacific Theater during the third quarter of 1945. That outside of that we haven't witnessed anything like we just did in modern history. So this slide shows us the components or the contributions to real GDP or economic growth by sector. And as you can see that, you know, scrolling over time, and this chart begins at the first quarter of 2016, that you know that these components jockey around. And sometimes you get a little bit more benefit from inventory, sometimes you get a little bit more benefit from spending. You know, we know by and large that consumer spending, which accounts for 70% of the economy, is generally going to provide some tailwind for you. And sometimes you get a benefit from net exports, and sometimes you don't. And in the case of the first quarter, we know that net exports was a little bit of a help, but then that was offset by, to a degree, by housing, by consumer spending. Then we had a slight retrenchment in business investment and business spending, as well as inventory drawdown. So that accounted for basically the negative 5%, if you will, in our GDP. Now, scrolling over to the far right, which is the number that was just released, which was really it was a number that we knew was going to be bad. You know, it was obviously predicated on consumer spending contraction. People were, even though some spending was actually up for essential products and things like that, and even towards the middle of the shutdown, people were buying technology and things like that. But by and large, consumer spending accounted for the bulk of the drop. We know also that housing had a weak quarter, even though it began to battle back towards the end of the quarter. And we know that also inventories were not being rebuilt, as many plants were shut down due to COVID, and obviously demand creation was not very strong. So you had a lot of manufacturers that were cutting shifts and reducing capacity. So these are the components, and you can see, just to highlight, that consumer spending was the big driver in the drop during the second quarter. So in this chart, we do kind of a before and after. So the first chart, which is the one on the left, is basically the sectors that were impacted in April. And we know that there was a shutdown essentially mid-March. We know the market kind of reached its trough in roughly March 23rd. April, again, was really in the throes of the pandemic and a lot of uncertainty. And so you can see the sectors that were most impacted. Again, you've got some durable goods, you've got consumer, very strong consumer related, you got grocery stores. I mean, all of those areas were bad. But ironically, as you go from the left chart to the right, you can see that in June, after some of the restrictions were lifted, after the environment and the psychology changed a bit, you could see that the sectors that were most impacted in April, ironically, were the ones to benefit the most in June, namely clothing, and then to a lesser degree, electronics, appliances, furniture, recreational goods, and then obviously bars and restaurants as the restrictions were lifted, even though many were reinstated, that nevertheless bars and restaurants, even at limited capacity, were net positive. So in this chart, we talk about the impact of the state, if you will, on real GDP growth. And so this is a kind of a rolling chart of the benefits of the not only tax and other types of programs, federal spending, and also the benefit of state and local spending on GDP in terms of percentage points. And so what this shows you is that the first couple of quarters of 2020 really benefited strongly, as we know, from a federal response as well as tax relief, that even though those quarters were negative, that there was a strong influence from spending, which really just underscores the issue that had there not been that type of stimulus or of that spending, that the GDP numbers would have been entirely worse. Now, what we do see consistently over the last 2 quarters at least is that we've had negative influence from state and local spending. And that's poignant in the fact that we know that there's lots of jurisdictions that are fighting tax revenue battles, sales tax revenue, probably not so much on property tax values, but that could come into play a little bit later as you see some flight out of larger cities and things like that, perhaps. So I would suspect that the negative influence or negative contributions, if you will, to U.S. economic growth from state and local spending will become more acute as we go along. And the real question to us is we kind of sit here at the beginning of August awaiting the next federal stimulus package of what that green area is going to look like over the coming quarters, and is what type of consensus are we going to wind up with when it's all said and done in terms of a federal package from Congress. So in this chart, we look at kind of the rolling estimate for third quarter growth. And so, having come off the first quarter, which was negative, the second quarter that was released last week, at least the first version, first pass at it, this really looks ahead to see, what's the current thinking on the third quarter. And as we kind of transitioned into the throes of the pandemic and the lockdowns, you really began to see the makings of what people were hoping would be a V-shaped recovery, and that's evidenced there in April, the expectations for third quarter really jumping up from kind of that kind of pre-COVID level of around 2% all the way up to 10%. And then we had some of the restrictions in the economy be lifted. People got more optimistic. That number went higher, 15%, and then even as we transitioned past Memorial Day and into June, that optimism really went, really skyrocketed to 20%. And so as we hit July, however, and we had the spike in COVID cases, and we had some of the adverse data and some of the, I'd say some of the, I guess, curbing of the momentum in the high frequency data. People were not quite going out as much as they had been, and not traveling as much, perhaps, that we began to see that estimate drop down. But if you look at it here today, I mean, it still suggests that we're going to have a very strong positive quarter for the third quarter ended in September. And so, obviously we'll watch this, and if the data, high frequency data, gets perhaps a little bit worse, you would expect that number to come down. But, clearly there's a lot of optimism that's built in the third quarter data. So this is a personal consumption expenditures forecast from Deutsche Bank, and the level of personal consumption expenditures, in this, as we look at the influence of the consumer, which represents 70% of the economy, on economic growth is going to be very, very important to watch. And so, notwithstanding what's going on right now, what are the expectations looking ahead? And even though this is from one particular research body, if you will, it does speak for the consensus in many respects, that being that it's going to take really a couple of years to rebuild the spending that's been disrupted here in COVID. And so, I think what this necessarily does is kind of helps to kind of keep in check our optimism with regard to economic growth. And even though in that last slide, there's a lot of optimism built into the third quarter, despite some of these headwinds and despite some of these known unknowns with regard to, China, the uncertainty of the level of stimulus, and we've got a lot of employee unemployment benefit programs that essentially ended without a clear path forward last week. And so, I think this just highlights to us that we're going to have to be patient insofar as the economic recovery goes, and then obviously expectations will play a big part into what happens in the stock market. So we know from this that we are going to have some consensus. Now, there's a Democrat package that wants $3 trillion of stimulus, and we've got basically $1 trillion of stimulus that's being proposed by the GOP. But we would expect it to be somewhere in the middle. But suffice it to say, from Alpine Macro's point of view, that if you didn't have the CARES package, you could certainly see where the impact of COVID would have really hit us in the gut. And so I just use this as kind of a talking point, lightning rod, if you will, to say we're going to have a lot of pain in personal income if there's not some extension being done. Now, I'm not a fan necessarily of extending benefits to companies that aren't going to survive this transition anyway. But nevertheless, from an income standpoint, and income is the mother's milk to spending. And if you're going to hurt workers that are already dislocated from the manufactured shutdowns earlier this year, and not give them some type of package, if you will, then we're obviously going to have a negative environment looking forward. So as we look at the Consumer Comfort Index, I think the key takeaway here is that, coming out of April and March, we knew that was had been torpedoed, and it was coming back. But we've seen a little bit of tempering here in July, and it hasn't completely rolled over, but it's clearly not going back up. And you can see from a relative standpoint, we still remain well below the index level that we saw earlier this year, that we had been tracking to over, frankly, a multitude of years. So we'll have to watch this because, again, kind of last few slides have focused on the consumer, not only their wherewithal, the risk factors, and this slide really reflects their psychology right now. And I think it's a little bit held in check. So before we get overly optimistic and buy into the notion that third quarter is going to be, from an economic growth standpoint, it's going to be up 18%, we really need to see these types of indices, these types of indicators be healthy. And so the next few data points on this particular chart are going to be fairly important in that regard. So I'm going to talk a little bit about precious metals and in particular gold. And we've done a lot of analysis of gold, and this chart on the left just reflects the raw price of gold, and it really continues to go up, and there's really a couple of key factors why. In real terms, of course, if you look at inflation, inflation-adjusted returns on the right, and that black chart is basically the spot gold price divided by the inflation factor, and so you can see that it has been higher. Certainly, gold on a ratio basis was higher back at the beginning of the last decade, but is beginning to reassert itself in terms of an interim high on that measure, because gold is high at a time where really inflation is relatively low, and probably expected to remain low for a period of time before it goes back up. And we do expect it to go up, but just to show you that on a relative and an absolute basis, you've had some fairly strong moves in gold lately. This shows you a little bit of the money flows in some of the assets that are tied to gold. On the left side, you've got the GLD, which is an exchange traded fund. This reflects total assets in there, and so obviously in the aftermath of the Great Recession, you saw a lot of flight to safety, and you saw a lot of interest in precious metal assets, and of course you saw more exchange traded funds that are tied to precious metals come into being, and this just takes into account one of them. But on the right, you can see kind of on a relative basis that what this tells you is that you could continue to see a fairly strong rise in gold, and this is data that comes to us from BCA, which is Bank Credit Analyst out of Montreal, but in their work, basically shows us that despite this rise, that you could continue to see more growth in gold, and certainly with the several key backdrops, which I'll go into next, it could continue to fuel more money flows into the precious metal, as well as more upside in GLD. So on a real basis, and these are really the two drivers. So when you look at a weak dollar and you look at negative real yields, you can arrive at the reasons why gold is doing so well right now. So you have a negative real yield, and on the left-hand side, you have the plot of the 10-year real yield treasury, a 10-year treasury real yield against the gold spot price, and you can see how tightly correlated they actually are. So, you've got the real yield actually inverted. So even though it looks like it's going up, it's actually going down. And in fact, it's about as negative as we've seen it, and almost close to negative 1%. And we've seen historic lows on the 10-year treasury, the nominal yield, which is around just slightly over 50 basis points, or half of 1%. But if you subtract the inflation from that, then we get to that negative 0.92% that's depicted on this chart. And so you can see very clearly on this simple level why gold is doing so well. And so when you think about the backdrop, and are we going to have a spike in interest rates? And if so, what would be the drivers? And I think when you ask that question right now, there really isn't anything to suggest that you're going to have a lot of heavy movement in interest rates from here. We know that the Fed is essentially an extension of the Treasury right now, and there's strong motivation to keep rates low to reduce the fiscal burden on interest payments on that debt, since there's so much Treasury debt that's now being issued. So don't feel like interest rates are going to go up that much looking ahead. So again, that provides a reasonably favorable backdrop for gold. On the right-hand side, you've got the dollar index, and you can see that the dollar is plunged, and it's kind of led to some speculation by some people that perhaps the dollar is losing its place as a reserve currency in the world. And I'm not sure that I would buy into that hype quite yet. But the trend lately has clearly been down, and certainly as you look from March, because we see the rest of the world beginning to open up at a time where the U.S. is still experiencing COVID-related hiccups. So a weak dollar coupled with a negative real yield on the Treasury, on the benchmark 10-year Treasury bond, are two strong reasons why we've seen a real pronounced move in gold lately. So, and this just shows you gold and silver plotted against each other. So even though we've seen a strong move in gold on a percentage basis, ironically, we've seen an even stronger move in silver. And again, there's some dynamics that play a little bit more heavily for gold than does silver, but needless to say that we've seen strong performance from multiple of the precious metals. So as we mentioned a couple of slides ago, we know that there's a lot of Treasury issuance to help finance the trillions of dollars of stimulus that's been put forth to date, and we expect that to continue to go up. And so you can already see that in this depiction in the Congressional Budget Office, in their estimates, that we will eclipse the federal debt level as a percent of GDP here over the next year. And in fact, they're projecting 108% of GDP. And if you look all the way back to World War II, I mean, we haven't been close to that. But the fiscal programs, the tax relief that we saw, as well as the deficit spending to finance wars and an expansion of government over the last decade, has certainly played a part in increasing debt as a percent of GDP. But clearly, we're going to be reaching uncharted territory here very, very soon. So I mentioned earlier the conundrum that we face in Congress, and the idea is that we've got to get people together to come to consensus. We know in the middle part of this chart, it shows you what's already been passed, and we know that a lot of this money has gone to small businesses. We know that there's been stimulus checks and tax breaks and health care. We've shown the impact of federal spending on GDP from an earlier slide in this chart pack. But herein lies the divide as you go from the red on the Republican plan on the left-hand side to the blue and the Democratic plan on the right side. And you can see the profound differences and really the impasse that we find ourselves in these negotiations. But while I do think that there needs to be state and local aid, you can see that the Democratic plan, which in aggregate is 3 times the size of the GOP plan, really focuses on state and local aid. And state and local municipalities and governments have to balance their budget. And so to do that, they have to pull the levers that are available to them. And if tax revenues are lower, or new business creation is not as strong, or even business destruction, it's going to impact them in terms of their ability to balance their budgets. And so the Democratic plan focuses much more heavily on that. But I do think that state and local fiscal issues are really going to begin to come to the fore over the coming quarters, certainly by the end of their next fiscal year in 2021. But as you can scroll up on the right-hand side, you can see that there's still a fair amount of spending for healthcare and extension of unemployment benefits. There is some basic consensus that needs to be addressed in the stimulus. It's just a question of how much, and coming to a consensus on that. And the Democratic plan, as you might imagine, focuses much less on business austerity as it does on individual unemployment benefit extensions and whatnot. So in our final chart today, we talk about the equity risk premium less the 10-year Treasury yield, and what that tells us in terms of attractiveness within the stock market. And so, the earnings yield is basically a measure of retained earnings plus dividend yield on the S&P 500 minus the 10-year Treasury yield, which we know is just slightly more than 50 basis points, and that level is very, very high with yields on treasuries being so incredibly low. We've talked about this in market minutes and over the last several weeks. And so a low interest rate level tends to inflate the ability for stocks to grow in terms of the relative multiples that stocks would be expected to attain. And this chart just tells us that stocks are generally more attractive right here. But the one thing we got to be careful about, and this requires a parsing of the data, is that the stock market right now is being led in large measure by a fairly narrow set of companies that are highly profitable right now. And so one can draw an easy conclusion that stocks are much more attractive right here, and I do believe by and large they are, but we've got a large we have a very narrow leadership of the market right now. So as you look at this, I think you take it you take it for for what it's telling you, that stocks generally are attractive. Just beware of that narrow breadth that we see amongst the index constituents. That will conclude our charts of the week for August 3rd, and hope you have a wonderful week. I want you to be safe. If you have any questions, cares, or comments, please let us know at the information you see below, and we'll talk to you again next week.